We are now going to cover leverage and margin. Forex is a leveraged financial instrument. Leverage is the ability to control a large amount of money using none or very little of your own money. Forex brokers offer up to 200 to 1 leverage. What does 200 to 1 leverage mean? If you were to buy 100,000 Australian dollar to the US dollar, you would only require 1/200th of the capital amount to take the trade in your trading account. This capital amount is called margin. The margin requirement to buy 100,000 Australian dollar to the US dollar would be 100,000 divided by 200, which is $500. Please note that leverage is a double-edged sword and can dramatically amplify your profits, but at the same time amplify your losses. You should adhere to a responsible money management plan and strategy at all times. I know from mentoring many private clients that over-leveraging your account can be disastrous. We will be covering money management in great detail in a later module.